Now people need to see and should see their advisor as that holistic planning, investment management, accountability, counselor, therapist, kind of wrapped all into one. Not just like, hey, I need you to go buy me, 1,000 shares at Walmart.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt Walters, and today I'm joined by Lee Mackey.
Good morning.
And Eli Freeman.
Excited to be here.
Yeah.
Oh, boy. And we are excited to be here. Got a couple interesting topics. Anything new? Anything new going on in y'all's world that you think the listeners should be?
We may be closer to 80 today than 70. I mean, it's spring-like temps after a record cold last week. Mm-hmm. It's crazy, but glad to see.
Yeah. Other than I feel like every conversation that we're having has something to do with politics or what's changing. That seems to be changing every day.
Yeah. Doge and Trump and all that's
he's been in office a month, and it feels like it's been a couple years.
Yeah, there's a lot going on. For sure, a lot of good things and things that we kind of wait and see how it unfolds.
Mm-hmm.
So first, we want to start off. Eli, you had a couple things you wanted to talk about.
Yeah, there was a really interesting Wall Street Journal article that came out. It was either Monday morning or Sunday. I can't remember which day I was reading it, but it was talking about who's spending money in America. Mm-hmm. And this is something that we've talked about in past podcasts, saying, because a lot of people are talking about how the lower class is pinched. Mm-hmm. And we've kind of discussed the merits of, well, the lower class really isn't driving the economy in some of the more significant ways. And I thought this article was one of the ways that you can kind of see where that's the case. And the article is writing about the top 10% of earners. So people making over $250,000 a year are currently making up over 50% of America's spending. Mm. And they go in and you can look up the article. It's Wall Street Journal. It's titled, "The U.S. Economy Depends More Than Ever on Rich People." But the top 10% of earners make up over 50% of spending. And when you start to think about that has some pretty large repercussions. So before I go into kind of my thoughts, what are your guys' initial thoughts on that?
That doesn't surprise me. I mean, maybe the 10%, I don't know exactly where I'd put that, but I can see where you hear it say the rich get richer, and and I think we're in kind of an economy right now that your higher incomes, those incomes are taking off and they're doing quite well. Inflation's not hurting them quite as bad. Mm-hmm. So no, I don't think that surprises me as a general rule. I may not have put it at the top 10%. I may have said top 25.
Do you think that has more to do with that changing? Because that percent is higher now than it used to be, right?
Yes.
Don't think some of
there's a chart on it.
Yeah. So do you think, genuine question, have no idea myself, but do you think that has more to do with the increase in income or the increase in asset values? Because you look at the top 10% of earners, they're probably also a larger percentage of people that own stocks and mm-hmm. people that own homes and mm-hmm. people that own, assets that generally appreciate and that have definitely appreciated over the last 5 to 10 years. So do you attribute that to pure income or just assets increasing? We were just talking about pledged asset lines of credit, right? I mean, where is that spending coming from? Is it?
I think it's wholly dependent on assets. You start to say, okay, the people who have the most amount of money that depend on their assets for some form of expenses. If someone's home is up, their stocks are up, their real estate is up, they're gonna go spend more money.
They have, yeah.
And the opposite would be true.
But hold on one second. But if you're saying that means you're tapping that. Because
maybe, but just your confidence is higher.
Okay,
it's giving you the freedom to spend, but
then the income has to be there. I guess to his point, the income has to be there just because mm-hmm. your house is appreciated 30%.
Some of this is a small example, but some of this is right. You saw the article where a third of or whatever of NVIDIA employees are worth $20 million or more.
Sure.
I mean, it's like crazy. I I mean, some of it comes from that, right? We've seen the technology boom over the last decade or so. How much of people's compensation is tied to, company performance and stock options and RSUs and all of that. I mean, that has to be a part of it where, their income, and I don't know how this is calculating income. Is it taking some of that into consideration, or is it just talking about like W-2 income? But that has to be a part of it, right? Because someone making $300,000 salary, but they're getting, $500,000 a year in stock options, and that stock is just year over year just crushing it, then yeah, they're going to spend in a much different way than the other person who's just making $300,000 a year and investing in a 401k.
And that's where I think, kind of opposite of what you were saying, Lee, I do think even if the income is the same, so say someone was making $250 last year, they're making $250 this year, but their assets go from, their assets go from $1 million to $1.5 million. Well, when it was $1 million, they may have been saving more aggressively, and they weren't spending. They were saving because they wanted to get the portfolio to rise. Well, now maybe they're getting closer to that number that they feel like they can go spend, and then their savings rate declines and their spending boosts just because of the psychology around, I'm worth more. I don't have to save as much. My portfolio is making more than I can even make a dent in when I'm saving. And there's strong side. And the opposite would be true of that. So that's actually what I took away more so from this article is a declining asset value. So stocks going down, real estate going down could have a more exacerbated type of effect on gross domestic product.
Okay, so that's an interesting question. So which one, right? Is it the chicken or the egg? Is the stock market going to be kind of the leading indicator for the economy? If we see a material decrease in value in assets, whether it's in the real estate market or the stock market, would that then trickle down and be kind of the catalyst that really starts to soften spending and economic growth? Or because a lot of times historically, and Lee, correct me if I'm wrong, but I mean, it's the opposite's true, right? You kind of look at the economy, and that's what gives you a good indicator of what the stock market is going to do.
Yes, but I don't think you can have it both ways. I mean, if you take Eli's point, then you almost would have to say then the reverse would be true as well. But I don't know, and I'm not 100% convinced on Eli's argument, because now you mentioned the 250 income and up. We have a lot of people in America who have seen their net worth explode with real estate, and their incomes are nowhere near 250. They're in that 150 range. And that doesn't buy as much anymore. I mean, you got a family of four now.
But
your
they're
house
not in the top 10%.
Correct. And so I was looking at it as a whole and not just the 10%. So I don't know. I don't know if the stock market, if we have a 30%,
I mean, that's going to, if NVIDIA crashes, right? NVIDIA employees, I guarantee, are going to change the way their habits and their spending, what they've done historically. And
100%.
That's just one company, but you multiply that across the board, right? The people that are currently looking at, hey, it's time to upgrade our house because Walmart stock is up, and that's a big part of our net worth and our income, and we can liquidate some of that. Walmart here recently has kind of sold off, right, from its all-time high. If that continued, then those people are going to be, their timeline's going to change, right? And their current spending habits in the real time is going to look a little different.
I think it takes a really significant catalyst to turn that around, like what you were talking about, Matt.
And I think it has to be significant. A 10 or 15% pullback in your 401k
off of two years of 20+% returns.
Well,
yes.
people get that. People that I'm hammering the NVIDIA example, but they've experienced plenty of 10 or 15% pullbacks.
Yeah.
And then and then they look up a year later and it's up 100%, right? And so I do think they can live through and ride through that. It takes something a little longer lasting and more material.
But I mean, there's a reason why, each month we look at the consumer sentiment index. I mean, there's some truth to that. I mean, what does the average consumer feel? I mean, we track it.
Yeah.
And I mean, it's important maybe less important, but I mean, it
And
is
whenever they feel
important.
bad, you buy, and whenever they feel good, you sell.
Well, and something on another thing on this too is just like your cash, right? You're getting paid. You've been getting paid the last couple of years 4 to 5% on your cash.
Yeah.
So if you're sitting on $500,000 at the bank or putting in a CD or treasuries or wherever it may be, and that's spitting off some actual income now versus what it used to, that's another source of, again, your assets helping boost your spendable, income for
Well,
that
and your
given year.
confidence as interest rates stay higher for longer, and you have a significant portion of your assets in those high yielding assets. Well, your confidence is pretty high.
Sure.
You can look at your assets and go, I don't care what the stock market does. I have a $5 million portfolio kicking out $200,000 worth of income.
Right.
If the stock market goes down, I still have
Like, I can just
$200,000
live off
worth of
that.
income.
Yeah. Yeah. Well,
Interesting.
Yeah. So here's an interesting article. This one was done by Smart Asset, and I saw the post from one of my favorite planners, Michael. I can't say his last name. Kitsis.
I say Kitsies,
It's one
but
of
I
those.
have no idea.
But a new study finds that clients working with an advisor would see a 2.39% to 2.78%, so roughly a 2 to 3% annual return premium based on investment and tax planning services over those without an advisor after you account for inflation and fees.
That was a mouthful.
That was a mouthful. So let me put it into simple terms.
For me.
A study shows that if you work with an advisor after taxes and inflation, you roughly make around 2 to 3% more than if you were to do it on your own.
Yeah.
And I find that to be kind of a fascinating thing, because one of the arguments that's against us every single day is, well, why in the world would I pay you?
Right.
And sometimes that's an elusive type of answer to say, well, we do tax planning. Well, we do investment management, risk management, cash flow planning, and all of that to come to a point to say that makes you exactly more money. Well, it's impossible. We can't. And obviously this study has probably some variance.
Yeah, it's broad. It's
In it.
kind of, yeah.
But to be able to say there is some value, even after you take out fees and inflation, there's value to having someone partner with you. And completely, it's a self-serving article. But it's interesting to me to be able to read these and say, okay, what we're preaching or what we believe to be true is proven just from different studies.
I love the plug.
Well, and we've said so many times on this podcast and in meetings with clients that so much of an advisor's job is non-investment or non-financial. I mean, it's walking them off the cliff. It's reining them back.
Well, that's what's so much has changed over the last few decades, right? With you used to see your advisor as almost like you kind of see a mutual fund manager now or an ETF manager, right? Of like, hey, they're just going to help me pick and put money in the right stocks. And that's still absolutely a component and a piece to it. But there's so much more. I mean, we're having conversations daily and weekly now about like what services can we add? Where are other ways that we can add value to a client situation that we're actively working on? Because now people need to see and should see their advisor as that holistic planning, investment management, accountability, counselor, therapist, kind of wrapped all into one. Not just like, hey, I need you to go buy me 1,000 shares at Walmart.
When you go to investment conferences now, as we all do, I mean, a big part of programs are the psychology of what we do, and it's we're meeting people where they're at. I mean, and partly because investments as a whole have become so commoditized. I mean, you can run out right now and buy Walmart stock for $6, online. You don't need free. Yeah, you don't need an advisor for that transaction. And so much.
And depending on the app, it'll make a cool sound that makes you feel good you bought it.
Yeah, cha-ching.
Ba-ding.
Yeah. Hey, before we zip to another topic, we were talking about upper class, middle class, and so forth. In Northwest Arkansas, what income do you think, with a family of four in Northwest Arkansas, what income before taxes do you need to have to be considered in the upper class of income?
The upper class?
So middle income goes up to what? in Northwest
So
Arkansas.
upper class being like top 25%
Yeah, or that you always hear upper income, middle income.
household.
Yeah, family of 4 in
Eli-
Northwest
Eli's
Arkansas.
got 72 questions before he.
It matters.
Yeah, it's interesting.
I would think.
I'm gonna answer second, so I can go high or low on it.
I think like 145.
I would have said like 350 to 400.
It's 180.
Oh,
okay.
It's 180. I mean,
I could be convinced.
in $180,000 in Northwest Arkansas.
Mm-hmm. I mean,
you're still
I was just
considered
looking
middle
at the
class.
Walton family. So I
Wait,
didn't know.
Yeah.
180 is still middle class, or 180 is
Well, 180 is begins.
the upper class?
Yeah,
class.
175, which I think everybody here would consider as a very good income,
Phenomenal income.
is considered
I
middle
guess I don't
class.
because I said 350 to 400.
Yeah.
Yeah,
Sorry.
what world?
Sorry, we're not living like Matt Walters.
What world do you live in?
The way you were positioning it, I was expecting this like way higher number
no.
than what it.
But I
$3
mean,
million.
but it is high. I mean,
The
you go
Waltons
to
bring everybody's averages
they,
up.
they probably do. But I think it's the cost of living. It's and the incomes up here.
Yeah.
So
Well,
I thought it was
also just know like family. I mean, I have a family of 5, right? It's just freaking expensive. Like,
yeah.
so $175,000, $180,000 is a lot of money and absolutely doable for sure. But I also know like Northwest Arkansas is kind of a little bubble, and
Yeah.
a lot of people make a lot of money.
Yeah.
I found that interesting.
I want to talk about an interesting post that Matt put out on LinkedIn.
Oh boy.
So Matt,
Did we approve this post?
no, I thought this was really interesting. So if you guys don't follow Matt on LinkedIn, you should go follow him on LinkedIn. Every now and then he puts something
Let's
good out.
go.
But
You're just full of plugs.
he
today.
put below are simple examples of federal taxes paid by a married couple filing joint returns. Okay. And I'm just going to do couple 1 and couple 3. If someone is making $100,000, they pay $8,000 in taxes, federal taxes. If someone's making $400,000, they're paying $76,000 in taxes. So someone who makes 4 times the money pays 9.5 times the taxes.
Wow.
It's a really good post, if I might say so myself.
I just think that's one of the ways that people oftentimes, especially, I think always we look at the next level of wealth and we say,
Sure.
well, they need to pay more taxes. Well,
We do.
Our system is broken because, and that's proof that because the second example is someone making just twice the amount of income pays 3.4 times the amount of income.
Mm-hmm.
So just the 100 to 400, that's a big jump in income, but 100 to 200, you're paying 3.4 times the amount in taxes.
So going back to the very first topic that we discussed, your top 10% income earners are not only carrying the weight of spending in the country, but they're carrying the weight of taxes in the country.
And typically you're
Interesting.
300 to 500. Those are people who are W-2-ish type of employees. Like
Sure.
you're not, you don't reach the 1099 employees at majority until you get kind of above the $1 million mark. So you still have plenty of W-2
And
employees.
I use those figures as example because unfortunately I know a lot of people, and I don't mean this in a direct attack on anybody, but I know a lot of people, they're not overly charitably minded, just generally speaking, from personal experience, from what I see. So these aren't people generally that are itemizing their deductions, right? So that's just taking the standard deduction, and that I think that's a very broad, example that applies to a lot of people. Make $300,000 or $400,000 a year, take the standard deduction, and that whole post was just around the idea. I get sick and tired of hearing people, on one side of the political aisle talking about make the wealthy pay their fair share, and the $400,000 mark is always
It's
the
always thrown out
threshold
there.
that's
Yes.
thrown out there, and it's like there's a lot of people making $300,000 to $1 million to $2 million a year that are paying a ridiculous amount in taxes.
Sure.
And so they're really talking about the kind of the ultra the billionaires that have the family offices and the structures, and they're working through the loopholes all legally, right? But they're just taking advantage of the tax code. That's who they're really wanting to target. But they bring it all the way down to everyone making over 400,000, we're going to make you pay your fair share, and it's like the math just doesn't add up.
Yeah.
To where that's true.
Mm-hmm.
So,
Interesting.
all right, Lee.
Well, this weekend, Warren Buffett released. Well, Berkshire Hathaway, Warren Buffett's company, released their earnings and so forth, and everybody studies his letter that he sends out to shareholders. The annual shareholders meeting, which has become such a popular event in Omaha, doesn't occur until May, but his letter is always one that's read by countless people.
And everyone should read it. I think
It's
that's
fascinating.
It's very educational.
Yes. He takes such complex subjects and, for lack of a better term, he dumbs it down for the rest of us. But 3 takeaways that I thought we'd kind of close this podcast with. First of all, one is first point: admit your mistakes and take sensible action. In the letter he talks about he's made mistakes. Over the course of his 70-year career, he's made mistakes, and his point is correct actions quick. Correct those mistakes quickly. If you've got a losing stock, he's like, don't get married to it, cut it loose. Second one is don't shy away from stocks, which I find very interesting given the fact that he is sitting on $334 billion in cash reserves. But his point is if you favor cash and bonds over stocks in the long run, you'll lose. And so, he's strategic with his cash positions. We were joking before the podcast started that, $334 billion could buy quite a few companies that are currently in the S&P 500. So point number 2, don't shy away from stocks as a long-term investor. And then third, which this is, picture Warren Buffett, go where the great bargains are. He's been a bargain hunter his entire life. He's not stopping now at the age of 95, 96. And that's just great. That's great recommendations, advice for any investor. Whether you are just starting out or whether you've got $1 million portfolio, go where the bargains are. Don't shy away from stocks and basically cut your losses, admit your mistakes, and move on. So, Warren Buffett, we'll always watch his shareholder meeting in May and come up with great quotes. And this will be the first year, though, that he does the meeting without Charlie Munger.
Yeah.
So it'll be interesting. He's announced in the letter, the succession plan at Berkshire Hathaway for when he is gone. But phenomenal company. So any comments or thoughts on that? It's kind of speaks for itself.
I can't add to Warren Buffett.
Yeah. Would you like to critique that, Eli? Anyway,
one thing kind of on a completely different topic. I was listening to a podcast that I listen to regularly, and Brian Belsky, that's his name, right? Yeah, he was on there this past week, and
he runs the capital markets for BMO.
Yeah,
huge.
Yeah. So he, one thing that was interesting though, and maybe it's because I'm a little old school when it comes to investing. I still believe there's value in value and not just pure growth and momentum. And so he got into all of these various factors. I don't know if you listen to this, but he got into these factors that they track and keep up with, and which ones are the most helpful and effective and have kind of worked over time. And one thing that I thought was really interesting is he said, now this is not a direct, I haven't done my own research or looked, but this is coming from Belsky. He said that I think there were 57 factors that they track or something. It was a lot. It was more than I would have guessed. Momentum is the worst performing single factor that you can use.
Really?
Yeah.
Huh.
And I was like,
you would have thought that would have been at the top.
That's all anyone talks about now.
Sure.
Like growth, momentum.
And that's what you hear about in the news is this stock is moving, this sector is moving. You should hop on. This one's not moving. You should sell.
Right.
Like that.
Yeah.
That's what momentum is.
It's like catching the momentum, like buying on the way up because it's going to continue that, right? And so I don't want to put words in his mouth but I think my understanding of that is like that's looking at a single factor, right? It's not that, hey, momentum can't be like a value added factor, something that you want to take into consideration. But if you just look at each individual factor in a silo, that momentum is the worst one, which, me is kind of like more of an old school, like, hey, it still makes sense to have exposure to like value and, lower priced and lower valued companies. And I'm like, Yes, that's what I want to hear. And we're starting to see it in the market where, we've said this before. We said it last year, and then it kind of reverted back to the way it had been. So, you're always kind of like hesitant to say, hey, this is the new longer term trend.
Mm-hmm.
But we just in the current moment, year to date, we are starting to see some shifts in the market with, hey, the growthy names aren't as growthy, right? And
Sure.
To use super technical terms.
Yeah.
And some value and some companies that are performing the best year to date aren't the exact same names that have been, where that's been true the last few years. And so I think it's a good reminder. I say all of that to say it's a good reminder. Nothing works forever. There's always going to be cycles and shifts. So this idea that like, hey, let's do this because this is what's worked. Not saying that's wrong, but that needs to just be one part of what you're taking into consideration when you're looking at building a portfolio and investing. And what got me going down that track was when Warren Buffett said, look for bargains. Yeah.
And believe it or not, there's a lot of them out there.
Sure. Yeah. All right. Anything else you guys want to add?
No.
We're good?
Good conversation.
All right. Yeah. As always, we appreciate you guys joining. Give us a like, subscribe, share us on social media. As Eli said, go follow me on LinkedIn. I'll start posting more. But we appreciate you guys. We'll see you next week.
Have a good week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. Mach 1 may only transact business in those states in which the firm maintains a notice filing or has qualified for an exemption or exclusion from registration. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com. Thank you for listening to the Market Moment podcast.